the sell-off that we're seeing in U.S. Treasuries. Let's listen in, guys.
I have no evidence that it's sovereign. We are still a global reserve currency, that we have a strong dollar policy. The dollar can go up and down.
Let's bring in Shidu Narayanan, head of APAC macro strategy at Wells Fargo. Thanks very much for joining us this morning. And we can start off there with what we just heard from Scott Bessent. Not concerned around this prospect that the dollar is losing its safe haven status. Not concerned about this moves that we're seeing in treasuries either. But what do you make of it?
Good morning, and thanks for having me. It has been quite a couple of weeks, hasn't it? The dollar has lost a lot of strength in the last, say, 10 days or so. But we think that in the near term, it is probably bound a quick rebound before it starts to depreciate again through the course of the second half of the year, probably into 2026 as well. So the reasons why we think the dollar potentially could be bouncing back is we're worried about a liquidity premium. There could be a tightening of liquidity. There could be a risk premium that's attached here. And also added to that, you could be having front-loading of imports that we're already potentially seeing. We're seeing exports to the US from Asia starting to pick back up as well. It did end of last year. It's starting to do that in pockets in March for this year. With the tariff pause, you could be seeing a front-loading of that as well. That combined with potential stresses in repo market and cross-currency markets, in basis markets, all of that could lead to a spike in the dollar, very near term. But that said, we think second half of the year, 2026, is a structural dollar weakness story. There's a lot of drivers that markets have discussed, which we subscribe to as well. The difference, though, is that dollar against EM and dollar against the risk havens is going to be a diversion. So you would see, say, the dollar generally softer against the yen, the euro, the Swissy. But dollar CNH, we think, is on an uptrend. Dollar Asia, we think, is an uptrend. Asia, high beta, trade dependent, all of these effects could be potentially losing out in the near term.
That sounds like more a DXY story than it is a BBDXY, I think, when you look at that. So give us a number in DXY. How low do we get this year on the dollar index against DMs?
Right. So near term, we think we could be seeing a 3-4% spike. Possibly even higher.
Okay.
But then towards the end of the year, you get back to current levels and maybe even lower than current levels.
Okay.
So for the year, probably slightly lower than where we are right now. And into 2026, even more downside.
And you're just taking a look there at something that's forming. We've already got the death cross for the S&P, but the dollar is also,
speaking of the DXY,
also nearing that same territory. What do you think then about dollar weakness and how that sort of offsets what we're seeing in the Chinese yuan as well?
Right. So the way we see China responding to this is one of the theses since the end of last year, beginning of this year, is that tariffs from the US is probably a done deal. It's certainly sticky. The extent of it, who is the target, how much do they go, for how long do they go, those were variables. But would tariffs be a thing for this year? Certainly so. And we also were fairly convinced that tariffs against China would be very sticky because the cross-currents and the undercurrents between US and China go way beyond tariffs. It's not just on trade, it's not just on the bilateral trade surplus or deficit that they're running. It's beyond that, which then meant that tariffs against China was probably very sticky. We also think now that the response from China is going to be potentially aggressive on trade and non-trade policy, but very cautious, very measured in the FX policy. We still see the dollar CNH higher, but we think it's going to be a grind up rather than a straight line spike up. So we think probably dollar CNH heading towards 750 or even higher through to the end of the year. But it's not going to be a tomorrow story. It's going to be a Q3, Q4, gradual grind up rather than a spike up controlled by the PBOC.
That's important because when you look specifically, and this is specific to the equity market, it seems that domestic investors specifically are more sanguine about tariffs, for example. But you're saying the risk premium that the market is attaching to China and tariffs right now might not be appropriate. That risk premium might need to be placed for longer on Chinese assets, generally speaking.
I think risk premium across the board, not just in China, but across the board,
okay,
is still on the lower side. It has gone up substantially since
it's
we
still
started.
on the lower side right now.
We think that it needs to be, again, the question is how sticky are tariffs and how long does it last.
Right.
If you're going to be going with the assumption that 10% is the base case, then probably it's fair. But we think that most of Asia at least would look at tariffs as 10% as the floor with more risk of upside on tariffs, which then means that you would need to be pricing in more. We're still talking about potential tariffs on semiconductors, we're talking about potential tariffs on pharmaceutical exports, both of which are key exports for Asia. And we also don't think that there is a specific level that the PBOC is looking at for dollar CNH. They will let it grind up. What they will be looking to do is to prevent an unruly depreciation. The last thing they want is market panic. And if dollar CNH glides up slowly, they're completely fine with it, we think. If there is any sign of potential panic setting in, potential one-sided depreciation expectation setting in, which the PBOC has been fighting for several years, then they would probably step in.
More risk aversion. How does that also play into the trading dynamics for the Japanese yen?
We've been very bullish on the Japanese yen since the beginning of the year. We think all of the factors that drive a stronger yen are already in place. Rate differentials. The dollar yen has been trading very closely on the 2-year rate differentials, the front-end rate differentials between the US and Japan, and that's going one way. You're looking at the Fed and pretty much everybody else easing rates with downside risk to growth. And we had been talking about the BOJ hiking rates. Probably they don't hike rates quite as aggressively now, but they're probably also not going to be cutting anywhere close to as aggressively as the rest of the G10 space, which then gives more downside for the dollar yen. And looking at the Japan story itself domestically, they're in fairly good shape. Wage growth is strong. Consumption could be better, but it's gotten much better. Investment sentiment amongst corporates is fairly strong. The spring wage negotiations, Rengo, have been phenomenal. Again, could be better, but they've been very, very good compared to where we were, say, just a couple of years back. So all of those should be driving the dollar yen lower. And we have not even talked about the risk premium that could be driving the yen stronger.
You know, I was actually going to ask you about, this might seem like a long question, but, you know, bear with me here. So this melt up we're seeing in, say, JGB yields, long end, right? You know, these are levels we have effectively never seen, if you think about it. Is that connected to what we're seeing in the melt up in Treasury yields? And on the latter, I'll just ask a direct question. You know, Treasuries are, you know, the bedrock of the financial system. They're supposed to be boring. You know, we're supposed to not notice them. But the fact that we're talking about them now, and I'm wondering on the Treasury side, whether you think the market is losing somewhat of confidence in the risk-free nature of Treasuries, and is that also filtering through, back to the Japanese story, into the JGB yields?
Right. I think I'll phrase it slightly differently. It's a diversification play rather than losing confidence in the treasuries play. So we were looking at 10-year treasuries early this year at starting at 450, but we're grinding up to 480, 485. It's come back down in that level. What's surprising is the level of volatility in the treasuries, as well as the fact that the treasuries have sold off at the same time the dollar is weakening as well. Usually that doesn't happen.
Right.
But we think that might be a one-off maybe. Looking further down into the year, we do think the treasury yields would be lower. We think that the dollar will be weaker as well. And JGB yields have been grinding up higher even before this episode. Since the last 6 months, we've been talking about JGB yields grinding higher. That could entice some of the foreign players to come back into some of the Japanese players who are in foreign money coming back into Japan, as well as foreign investors coming into JGBs as well. Far more attractive yields, like you said, yields that we've not seen in a long time now, which should entice some capital flow back into Japan, which again should be supporting the yen.
Chidu, 10 seconds or so. ECBs this week, do they cut? That's part number one. And part number two, 114. I'm traveling to Europe next month. Do I change my money now or do I wait for a month?
You're looking at Hong Kong dollars.
Yes.
Yes. So we think that the euro is going to be a strong story.
Okay.
We are quite optimistic on the euro. Structurally, things have changed.
Right.
You're talking about substantial fiscal stimulus from euro area. You're talking about potential productivity growth. Again, we're not comparing Europe to US like for like, but the direction of travel, which is more important for the cross, and the direction of travel for European Union is stronger growth, and the direction of travel for the US is weaker growth. So euro stronger. If you're buying euro, buy it right away.
Okay, there we go. All right, buy it now. Fantastic. Thank you so much. Chidu Narayanan, their head of macro strategy, APAC at Wells Fargo. Coming up here on the China Show, President Xi calling on Vietnam to oppose unilateral bullying as Beijing aims to strengthen ties in the region. The latest on his Southeast Asia tour. Coming up next.